Welcome to Back to Management 720. Let's get started with Chapter 9. With Chapter 9, we are going into the final section, the final 4 chapters of the book. And just as a recap, the first 4 were short-term decision-making, where we learned about fixed cost, variable cost, contribution margin, how to calculate things such as break-even. The middle 4 chapters, which you're probably aware of, having just taken the test, having to do with how do we figure out indirect costs. We look at job costing, process costing, service and departmental costing, activity-based costing, all of these sort of things to figure out costing, primarily for the purpose of the more accurate our costing, the better our pricing is. And then these last 4 chapters are long-term decision-making, and we're starting off with budgets. Budgets are our starting point. So let's go ahead and get started with budgets. Budgets traditionally are not something every company enjoys working on, but they're necessary. I don't want to say they're a necessary evil, but they're a necessary discipline, and that helps us develop a planning process. We should always be working on our planning and our procedures in a company. There's so many companies that feels like every time we went through the budget, it feels like we're doing it for the first time, like we're reinventing the wheel every time. So it shouldn't be that way. Part of a company's overall way of working should be whatever troubles or whatever things we go through, we should learn from that and create a process around it so that it is easier and more efficient the next time around and update it as necessary. So what are some of the good things about budgeting? Well, it compels planning. It causes us to think about the future, and it takes our minds up and out of immediate issues. Too often in a company, we can be just focused on the day-to-day putting out fires, but we need situations, or we need parts of our process to take us out of the day-to-day issues and think about long-term issues. It hopefully promotes communication coordination. Too many times departments are just sort of focused on their own silos, what are good or bad for their own silos, without having any thought of whether or not what they're doing, while they might be good for that department, might be actually hindering another department. And that causes, or should cause, managers to interact. That's the whole idea of this, return to work, is that there's maybe not economies of scales, but there's some efficiencies that can be gained when people interact and talk between departments. The whole water cooler effect of people understanding at the water cooler what some other departments' problems might be. Also, a budget, if you want to have a fair and transparent process on how do people get bonuses or promotions, it should be on something that everyone has agreed to, or even if you haven't agreed to it, it has at least been communicated ahead of time. So a budget is something that is a basis of valuation and should be transparent and hopefully fair. This last one, this book has added risk management. While that is an area that a managerial accountant will be focused on, or more up the food chain, a CFO would be focused on. They're focused a lot on risk management. I don't know. That's why I have this in maybe, in parentheses. Maybe if you're good at budgets, you will think beyond the budget to understand what are the implications of the budget. So if you have a certain amount of sales, you may ask yourself, what is the risk that we may not get those sales? What could be happening? Or if you may have budgeted a certain level of cost, you may ask yourself, beyond the level of cost, what are the risks of our vendors? Maybe we have a vendor that's close to going broke, or we may have material prices that are increasing. So there's a lot that goes into risk management. It's a whole separate subject, and it's a very good subject. And as you get better at running a business, you'll find that one of the in-game topics that you will end up talking about a lot is risk management. But whether or not budget stimulates risk management, I would say it could be the basis, the beginning of it, but I wouldn't say that's one of the primary purposes of budgets. But I add it here because it is a good topic to, I guess, introduce and talk about a little bit. For learning objective 2, here are just some approaches to budgeting. I would say these are sort of generic and just sort of gets you into the mode of understanding how to look at a budget. In case you have a different type of budget that you need to build, there are different ways of looking at it. The most common, or the one that we're going to look at here, is probably output versus input, because we're looking at a manufacturing environment. And so what do? We have a certain level of sales, for example, and then we say, well, if we know this is the level of sales we would like to achieve or to budget, well, then we know according to our standardized, cost and measurements, we say if we want to sell this many products, we need to build X amount of products. And if we want to have to build X amount of products, we have a standardized set of materials or a build schedule for those. And those are all based upon a standard composition. And so if you know the number of outputs, you can back figure the amount of production and the amount of purchases and other things as well. Now, of course, in the previous couple of chapters, we looked at activity-based things, and this is similar to output versus input. It's just maybe taking it to a little bit more complex level, to where rather than looking at individual inputs, we may be grouping them together by activity or by department or by cost drivers. So it's just recognizing that the output input is an approach, but as there are multiple inputs, you try and find commonalities among the inputs so that you end up going towards an activity-based. Incremental, this is sort of a government or a nonprofit thing. The idea is that if you've already justified your budget up to a certain amount of dollars in the years past, you would probably ask for the same amount, and if you ask for any more for budget, you would have to explain the incremental increase in the budget. So as you can see, this is not something that would be necessarily in a for-profit organization. And then again, another sort of governmental nonprofit thing is a minimum level. In other words, let's say you're a city agency and you know that you have to have a certain amount of services. You may go through and say, what's the minimum amount of funding that each of these services need to stay open? And then if you have excess funding, you would then go ahead and rank them in order of requirements or needs and fund them as necessary. And a related approach is called zero-based budgeting. Rather than going to the incremental where the previous year's budget is already taken as a given, you would go through and you would just reevaluate every cost from the ground up for each department and then rank accordingly. But as you can see, that the most common and what we'll end up doing is sort of output and input. If we start off with sales, then we can back figure how much we produce and how much we purchase, et cetera, et cetera. Okay, so I actually combined learning objective 3 and 4 in this particular outline. And the book, this is the meat and potatoes part of the chapter. It goes through all of the master budget, which is what we have here, and all of the sub-budgets, but subsidiary budgets. But it seems like no two textbooks are alike in how they propose the organization of the master budget, the operating and the financial budgets. And I look at them, and of course, since I've taught this for so long and managerial accounting is my primary focus, I find that most of them miss the point. So I have come up with my own little chart here, and I think this is a much better depiction of what's going on. So let's take a look at the different things that we have going on here. So we have two areas. We've got an operating budget and a financial budget. The operating budget deals with product, everything necessary to do with the physical element of running a business, whereas the financial budget is the cash. And typically these are going in opposite direction. In other words, you buy materials from vendors, you take them and you make things, and then you sell them on to wholesalers who sell them on to the final customer. Whereas the cash goes the other way. You get cash from the customer to the retailer pays the wholesaler pays the manufacturer pays the raw material vendor. So these are going sort of in opposite directions, at least the flow. Now you'll notice that for both of these budgets, what is the very beginning part? The very beginning part is sales. We all, so this is not an accounting, a managerial accounting decision. This is a marketing department decision. Marketing makes the decision on what they think is the level of sales. From there, we go ahead and two things start happening. So in the financial budgets, I've intentionally put the cash receipts and the cash payments in a certain position. In other words, they are lining up horizontally with their counterparts in the operating budget. So sales, what can we determine from sales? Well, whatever the volume of sales that we're planning on doing, isn't that how much cash we're expecting to bring into the company this year? So sales determines how much cash we're receiving. From sales, we go to production. Now, just because we're going to sell a certain amount doesn't mean we're going to produce the exact same number. In other words, most of the times we're not starting from zero inventory. So sales interacts with production. This is when it gets into the manufacturing part of the game, where production is looking at what is its beginning inventory and ending inventory and taking into account how many items they need to build to meet sales. Now, sometimes companies are building inventory in and above sales because perhaps they're reaching a peak season. Like for those companies that are getting ready for Christmas, they don't just automatically go from non-Christmas production to Christmas production in 1 month. They typically, for capacity reasons, they start ramping up a couple of months before Christmas, so they may be laying in inventory. And similarly, let's say it's after the Christmas season, even though there are a certain amount of sales, maybe they've overproduced or they have extra inventory, and so their production might be a little less than sales. So in other words, production won't match sales or hardly ever matches sales exactly, because production has other things in mind that they're trying to take into account, and that's basically how they're managing their inventory. Well, once we have production, what's the level of production? Well, we know manufacturing is based upon direct materials, direct labor, and manufacturing overhead. So these three red boxes are our manufacturing costs, which is what we've seen before. And outside of that, remember, those are called the product costs. And then we have the period costs, the things that are not directly traced to manufacturing. And they include, the CEO salary, the headquarters, the selling commissions, the administrative things. But those are all still based upon typically what is the level of sales. In other words, selling commissions are going to be estimated based upon what we think the sales are going to be. Now, those four things, the product cost and the period cost, well, those are the things we're going to be paying cash for, or sometimes we're paying on account, but we're going to be budgeting our cash versus what we're paying on account based upon these four. And that's why I put cash payments on the same line as these four items, the three product costs and the multiple period costs. There's actually, you could probably break those out, but they all fit into one category. So sales determines cash receipts. These four costs determine cash payments. And then of these three, you go ahead and figure out COGS. Now remember, that's cost of goods sales. So even though these production costs figure out our per unit cost, we're going to be basing COGS, and there's not a dash line, but there probably should be. Remember, it's not cost of goods manufactured, it's the cost of goods sold. So we'll use these three to figure out a cost to produce each unit, and then this number will be based upon how many we sell. Now, all of these are expenses, right? We got product costs, period costs, COGS. Those all kind of feed into our budget income statement. Whereas over on this side, and I'll explain CapEx in a second, our cash receipts and whatnot typically get funneled in, are the primary building blocks of our budgeted balance sheet. Now, of course, there is some crossover. There are some things from this side that come into the balance sheet, and this goes into the income statement. These are just the primary items of each one. Now, what is CapEx? CapEx stands for capital expenditure. Remember, operating budget is sort of our day-to-day business. But in order to produce some of these things, we need to plan ahead and get ready to buy new equipment when we need it, or sell old equipment when it's used up, or buy new factory space, buy land or build a building. Now, those are heavily based upon, do we have the cash to pay for it, or if we're selling off a piece of equipment, we get some cash from selling a piece of equipment. So capital expenditure is not part of production. In other words, it's not tied to sales, not tied to production. It's based upon its own sort of cycle of when we've depreciated or when we've used it up. But we're going to be, the decisions about CapEx are more related to what is our cash position than what is our production position or sales position. So that's why it's sort of a dashed line. It's a slightly different color. It's more included in our budgeted balance sheet because a balance sheet deals with long-term assets, which is what capital expenditure deals with. And it deals with, do we have the amount of cash necessary? So that's how all of these budgeted elements work together. Now, each type of budget, there will be a budget for each of these. There'll be a budget for sales. In other words, this is the master budget, but each of these subcategories will have a budget. Now, each of these subcategories have a slightly different looking budget, but there are some similarities between some of them. And so what I've done here is I've sort of summarized like 10, 12 pages worth in the textbook into just what you need to know as an MBA student. There are going to be similarities between them because of the type of information they're dealing with. So some of these budgets are going to be just a direct effect. And the two that I have examples are the sales revenue and the labor budget are just a straightforward calculation. In other words, sales revenue is going to be, well, how many units do we plan to sell? What is the price per unit? That's going to be our budget. There's no sort of, it's a very direct calculation. Same with labor costs. They're saying, how many items are we going to produce? And, so how many items we're going to produce requires a certain amount of hours worth of labor. And what is the rate that we pay our employees? And so that's a kind of a very direct effect. There are going to be the production and the materials that have to take into account beginning and ending inventory. What is our beginning inventory? What is our ending? What is our projected ending inventory? And therefore, we're going to take whatever the thing is upstream. So production will take sales and it'll add it to its calculation to figure out, okay, I have this amount of inventory. This is how much they want to sell. I need to build enough to cover sales, plus take into account where I want my inventory to be at the end of the month. Because this is a situation where managers think in a continuous process, whereas the budget has to be done on sort of a month-by-month schedule. In other words, we're not building from zero to, let's say we're going to sell 2,000 items this month. We don't start at 0 items, build 2,000, then sell all 2,000 and start at 0 again. It's going to be sort of, we're going to build a little bit each day. We're going to sell a little bit each day. In other words, it's going to be more of there's going to be more of a buffer amount of inventory to prevent us from selling out. So, production and materials are, so production is based upon sales, materials is based upon the production number, and it's going to be an inventory target. And rather than go through it too much right here, I'm just explaining the type of budget it is, and then we'll actually have an example in the homework. There are going to be a couple of them, SG&A and overhead, that function. The type of budget they have is part of the cost are fixed costs, part of the cost are variable costs, and you just have to calculate them. I don't think I actually have any of those because we've done plenty of fixed cost, variable cost calculations. We're going to have like one sales revenue calculation, 1 or 2 inventory target calculations. I don't think I have a COGS because that can be a little tricky, but just realize that what we do is we take the materials, labor, and overhead costs, we figure out a per unit cost for each of those, and then we figure out, we multiply by the sales volume to figure out what COGS is, because that's what our budget for the income statement will be. On the cash side, we're going to have a rolling window. And that's because, let's say we budget X amount of sales. Well, remember, sales come in basically 2 varieties, a cash sale or a credit sale. So some of the sales we're going to budget and saying we're going to get the cash right away for all the cash sales. For the credit sales, we're going to say some of those people who buy it on credit are going to pay it off in the same month. So we'll get some of that cash. Some of them are going to pay it off the month later. Some might pay it off a couple months, 2 months down the line. And so that's why I call this a rolling window. When we're talking about cash receipts, some of it's Some of that cash is actually being received that month. Some of it is being received in future months. And we can say the same with cash payments. So these are all the expenses. Now remember, an expense isn't necessarily cash. So we could buy materials, but we could buy it on credit. So we're going to do one homework question where we say, these are all our expenses, but some of our expenses we pay off this month. Some of our expenses we pay off the month afterwards, and that sort of thing. So while there's a rolling window for cash receipts when cash comes in, there's also sort of a rolling window for when we pay out cash. And those two, and I have more homework questions focused on those two, because I think the real learning lesson for the MBA student in budgeting is not necessarily getting your production numbers all down right. There's a lot of detail, and that's why you have accountants. It's more understanding your cash position. A lot of times businesses fail because they don't understand when is the cash coming in and when is it going out. And so we're going to focus a little bit more on cash receipts and cash payments, because I think that is the necessary thing for MBA students to be more aware of. And then capital expenditure. Those of you who are taking finance, I think there is a class, part of the class that talks about net present value. If you've done a net present value process, you understand how to evaluate capital expenditure or any project that requires an initial cash outlay and a return over time. We do cover that in accounting, but we don't cover it in this book, or we don't cover it right now. But just be aware that there is a process for identifying and approving capital expenditure products. This last learning objective just talks about how budgets affect the behavior and other parts of the business besides just the planning part. So depending upon the type of budget you have, whether it's top down or bottom up, could talk to the amount of employee participation. I'm going to say that most budgets are top down. They're figured out by management and just told to the employees. And that saves time. Fewer people are involved, and therefore things can be overlooked. But, budget is a fairly, ordinary sort of process. And so when things get out of whack, it usually is brought up and the budget can be changed. However, if you're in a new type of business, or if you're launching a new type of product, or there are just some companies that are a little more proactive, they might take a bottom-up approach where there's more input from employees. It's partly for buy-in, but it's also partly for identifying potential pitfalls. And I remember when I was at running a grocery store, a big grocery store, one of those, ended up being bought by Whole Foods. So it was one of those Whole Foods type of grocery stores that the year that I got there, they decided to have the managers develop the budget within guidelines. And I had a ton of budgetary experience. And so I was able to do mine very quickly. And in fact, the budget, the template they gave me was really off in a lot of areas. And at the end of the year, I was within 1% of my budget, which is amazing for something like a grocery store where other people are, miles off. And it just goes to show that once you have experience at budget is a good tool and a good experience to get in. So even if you're not in charge of a budget, just participating in the budget, if you have the opportunity or looking at it, is very helpful. But budgets also introduce the term budgetary slack. And what is that? Well, human nature is to always game the system. I hate to say it. A lot of times I say human nature, the primary point of human nature is to find the loophole in whatever system they're working in. So budgetary slack is just that. It's the intentional setting budgetary goals low so that little effort is required to achieve. And of course, you could set them too high, and that's bad also. So, there is a Goldilocks area to where they're challenging but fair. And that's what the company would like to see. They want you to to challenge yourself, but not, but also be able to or at least you hope the company believes that you should be rewarded if you've put in a good amount of effort. But getting to that Goldilocks zone of budgets takes time and effort to develop and experience to understand. Most budget periods are annual. That fits the financial statements, but there are other types of budgeting periods. I had a joint venture partner that was a clothing company, and they really did their budgets according to seasonal, the spring season and the fall season as far as fashion. And so, those were two different sets of, I don't want to say customers, but they were a different set of vendors, different set of materials. The amount of R&D that went into those two different clothing lines were very different. And so their budget was on a seasonal budget. Also for those that that's less than a year. Whereas there are some multi-year budgets for those big construction projects. Let's say you're building a ship, like a cruise ship, or you're building a building or a dam or something like that. Your budget period might be the life cycle of that particular piece of either infrastructure that you're building, or if you're building a large object. And sometimes, if you get into accounting more, and there are contracts that are staged. In other words, once you complete 25%, 75%, or whatever, that those are milestones within long-term contracts, and sometimes the budgeting period is by the milestone, so that you can, because at the milestone you can see whether you're ahead or behind in costs. So it makes sense to match your budget period to the milestones. There are also certain types of companies that are fast-moving, like financial companies, that are always looking at not a year. They just want to know the next 2 quarters, the next 4 quarters, how are we doing? And so there are continuous or rolling budgeting periods. So your company, whatever you're working in, may not work. Most go on an annual basis, but if you find that one of these other types of approaches is more useful, use them. I mean, your accountants still have to report on an annualized basis, but your budget is an internal management tool to run your business better. So use the thing that helps you make better decisions. Also, budgets sort of, engender forecasting. I took a little different approach than the textbook. Typically, when I think about forecasts, I think about, okay, internal to our business. What are the costs? What are our staffing? What are our sales? And then I look outside our business to other people in our industry. What is the competition? What are the trends? Where do I stand? Am I best in class? This is where benchmarking might come in. I might be, trying to forecast if I want to move up from 10th on the list to, in the top 5, that would be something I would have to budget in, right? That would be a forecast that I would have to put into my budget. And then look at the overall economy. During COVID, is everyone down? Are interest rates up? That was another thing that was, how does that affect us? Those are something outside of our business, outside of our industry, that's at the economy at large. And last but not least, in the book, they call this sort of ethics and transparency or something like that. I kind of see this as sort of an audit of your budget process. If you have managers who are developing a budget, there is some responsibility on upper management to go through and make sure and do an audit. Are these expenses legitimate, or are they baking in some things to cover up little pet projects? Were their reported results previously, on which they're creating their current budgets, were the reported results accurate? And was there good participation? Were the people necessary to build the budget all actively participating? There are other ways you can audit the process, but I think those are kind of the top 3: expenses, reported results, and participation. Okay, let's move over to homework. So we have, let's see, 1, 2, 3, 4. So we have 7 items that are on the homework. And you'll notice here that the last 3 that the last three are going to be done in Excel. Now, we haven't done a whole lot of Excel work, and there's not going to be, I guess technically you don't have to do these last three in Excel, but you're going to find out that you probably do want to do them. So you can notice here, these last three are all cash collection, class disbursements or payments, and then what happens if you have a revolving credit line? How do you work that into your cash budget? And so I've also got here collections, and then I've done a purchases, a productions, and an AP budget. And these are just simple and fairly straightforward. And sometimes you have to use different tools, but I'm trying to show here that you can use relatively similar tools to cover at least three of these four. Okay, let's take a look at the actual questions. Okay, so starting off on question number 9. Okay. Question number, let's see, let me get this. Number 9. We have sales budget for next month of 1.2 million, cost of goods sold 25%. All goods are paid for in the month following purchase. The beginning inventory is 600, ending or 60, ending inventory is 76.8. Beginning accounts payable is 192. Okay, so I'm just going to first show that it says, what is ending accounts for the month? Well, it says all goods are paid for in the month following purchase. So this beginning accounts payable is going to be paid. It's going to be paid all the way down to 0. So the only thing that's going to be accounts payable are the purchases from this month. In other words, we're not going to have to worry about any of the previous month's purchases, because the 192,000 purchase from previous month, because it says all goods are paid for in the month following purchase. So the 192 is from last month. It's going to be paid off this month, and therefore the only thing that's going to be left in accounts payable is the things that we purchased this month. So basically, we need to take this other bit of information and figure out what is purchased this month. Well, first of all, let's take the sales of 1.2 million and times 25%. That is going to be our cost of goods sold. And let me get my calculator going. And that is going to be, that's going to be 300,000. Now, what is the way I'm going to approach this? So if I was teaching a straight up accounting class, I would be using T accounts. But I think the way I'm going to approach this is I'm going to approach this based upon the inventory equation, because I think that's a little bit more common sense and it's a little bit more widely applicable. When I was saying I'm going to use one technique for 3 of these 4 questions outside of Excel, that's what I'm going to use. I'm going to use the inventory equation, and that should help us figure things out. So what is the inventory equation here? Now, inventory equation always has a beginning inventory and an ending inventory. And what you need to figure out by reading the question is, what is the amount coming into inventory and what is the amount leaving inventory? So whatever the amount coming into inventory, the incoming amount, that goes with the beginning inventory. And in this case, whatever's coming into inventory, in this case, is purchases, right? And that has to equal whatever is leaving inventory plus ending inventory. And what is leaving? Well, these are the, whatever is leaving inventory is what we sell, or cost of goods sold. So beginning inventory is going to be 60,000 plus, well, purchases is what we want to know, right? It says the ending accounts payable, whatever's in the ending accounts payable is going to be what we purchased this month. And what is left, the inventory, what we sold, is going to be what we calculate that, 300K. And then ending inventory is going to be 76.8. So purchases are going to be 300 plus 76.8 minus 60K. And so you can see, just offsetting those, it's going to be an increase of 16.8. So that's going to be 16,800. So what is left in AP? The purchases from this month. And we figured that out by using the inventory equation. And let's see, fill in correct response, 316.8. Okay, so let's take a look at number 10. Number 10. It needs to know the anticipated cash inflows for the next quarter by month. Cash sales are 25%. Historically, sales and account have been collected 50 in the month. Okay, so this is the one that I'm not going to use the inventory equation. This is what we call that rolling window. But we're going to do this by hand, but this is essentially, we find out that this cash collection, if I may just bring up this, I just may point out here that this is the one we're doing right now, cash collection. I'm going to do it by hand, but you notice these last three are all cash budgets that we're doing in Excel. So what I'm doing here by hand, you're going to find out very quickly, oh, it makes sense to do this in Excel. So we'll do a simplified one with question number 10. We'll do a simplified version with question number 10 by hand, and then when we get to 13, 14, and 15, we'll do those by Excel. So let me bring up this again. Okay. Historically, sales and account have been collected as follows: 50, 30, and 20. 50 in the month, 30 in the month after, 20 and 2 months later. Gross sales by the quarter projected. Accounts receivable on December 31st were 24,000. What are the cash collections for March? Okay, that may seem like a lot of information. And the first time you approach one of these questions, it does seem like a lot of information. First of all, we can essentially ignore this thing. And why do I mean that? It says of the cash sales, 25 are collected in the or cash. 25% of the sales are collected in cash in the month. Of the sales on credit, 50 are in the same month, 30 in the month after, and 20% 2 months later. So here, this is the amount that was sold for December, or that was still left from December and earlier. But think about that. There's going to be X amount in the month, then there's going to be X amount in the month after, and then an X amount 2 months later. So whatever is an accounts receivable will have already been collected by February, right? 1 month later is January, 2 months later is February. So whatever this amount is, we're not worried about because it will have all been collected. Now, it's not to say that other amounts won't have gone into AR, and we're going to look at that, but this particular number doesn't affect us because this amount will have all been collected by the end of February. And we're looking at cash collections for March. So this is a don't need to know. So if I were to set up something here, let's see, how would I do it? I would do January, February, March, and I'm just going to extend this April, May. Now let's see what if we just look at March, and if we just try and understand the collection for March. So whatever the number is, there's going to be sales, right? And then we say of that sales, cash is going to be 25% of it, right? That means credit is going to be 75, the other 75%. So whatever this number is, it gets divided up into two categories. Cash, so in other words, of this 32,000, 25% is going to be in cash and 75 is going to be on credit. Of the credit, now of this 75%, 50% gets collected in cash this month, right? So what we do is we take sales times 75% to get the credit amount, and then of that credit amount, 50% of that, so you can see where we're going to be multiplying 75% times 50% to get times sales to get the amount of the credit sales collected in this month. Now, here's the interesting thing. Of the rest of the credit doesn't get collected in March. It gets corrected in April. So this is March 30% of the credit, right? And then what do we have in May? We have March, 20%. Well, 20. Remember, this is 30% times the 75, 20% times the 75. So now, are we concerned about this number and this number? No, we're only looking for cash collected in this month. So this is cash collected in this month, and this is cash collected in this month, right? Now, we may think, are we stopped there? But if we have this pattern, you can see this is sort of a diagonal pattern. Isn't that the same thing with February? February is going to have sales, and it's going to have cash as 25%, and the other part of that sales is going to be in credit. Now, of that credit, 50% is going to be collected in the same month, but we can say 30% of February's credit sales are going to be collected in March. And same with January. We can say January sales, there's going to be cash, 25%. There's going to be credit, 75%. 50% of that credit is going to be collected in that month. 30% is going to be collected in that month. And then we say 20% of January's credit sales are going to be collected this month. So what gets collected in March? The cash part of the sales for March's of March's sales, 25% is in cash, so we count that. 75% is credit, and of that 75%, 50% gets paid in March. So 50 times 75 times March's sales. And then what are we going to do? We're going to do 30% times 75% times February sales, then 20% times 75% times January sales. Those are the numbers that we need to know. So if we put it all together, it would be 25%. So this is the cash, March sales cash, which would be 32,000, 25% times 32,000, and that is so that's 8,000. And then we're going to say March's credit, the part that we collect in cash, is going to be, well, 75% times 50% times 32. And that's 12,000. And then we're going to say February's, the amount of February's credit sales that we're collecting in cash in March is going to be 75% times 50%, but it's based upon February sales, right? So February sales is 8,000. Oop, I don't think that's the right number. I think this thing doesn't seem to multiply in series very easily. I see the problem. 30%, right? Because the month after is 30% and the following month is 20%. So times 0.75 is 6,000, times 0.3 is 1,800. And then the cash that we collect from January's credit sales are going to be 75% times 20% times January sales, which are 16,000. So 16,000 times 75% is 12,000 times 0.2 is 2,400. So we add those up. And I get 24,200. So you can see how this might lend itself to being an Excel task. So let's just double check. Only correct response 24.2. Okay. Okay, let's see. Let's move on to question number 11. Bolt company manufactures boxes. It takes so this is a materials purchases. It takes 22 units of wood, 1 unit of plastic. Schedule production boxes for the next 2 months is 1,200 and 1,800. Beginning inventory is 96 of wood and 72 of plastic. Any inventory of wood is planned to decrease 2,400 units each for the next 2 months, and the plastic inventory is expected to increase 12 units. Again, a lot of information, and if I was teaching an accounting class, I'd be using T accounts and Excel. But here we can actually get through what they're actually asking us is relatively straightforward, so we don't need to use all that information. We can use, again, like we did with question number 9, we can just use a simple inventory equation. So it says, based on this information, the number of units of wood that Bolt needs to purchase during the first month is. Okay, so we can take beginning inventory. Now what comes into inventory here? Well, we're looking at a purchase. So purchases are incoming, and that has to equal what is outgoing. Well, it doesn't say the word, but production, or it does, scheduled production. So what's leaving is production and ending inventory. So the key with when we do a materials purchases is we have to remember we have to convert production numbers. See, these are production numbers, number of boxes. But what we're talking about is purchases of what? Purchases of wood. So notice that we don't have to do both wood and plastic. We just have to focus on wood. So we need to make sure that when we are doing our numbers here for the inventory equation is that we're converting everything into the correct units. And the correct units here is units of wood. Not number of boxes, units of wood. So here, what is the beginning inventory of wood? Well, it's 9,600 units. We're trying to figure out how many units of wood we need to purchase. It says we're producing, well, for the next 2 months, it says 1,200 and 1,800, right? So if we're producing 1,200 boxes, how many pieces of wood does it take? How many units of wood? It takes 22 units of wood. So we need to convert this number, production, into a wood number. And then ending inventory, it doesn't tell us what it should be. It just says it plans to decrease. Well, if it's 9,600 now, and it needs to decrease by 2,400 at the end of the month, well, what do we want to end up at? We want to end up at 2,400 less than that. So that's going to be, well, 96 minus 24, that looks like that'll be 7,200. So you can see, just by reading it carefully and not getting too caught up in the details, it comes out to a simple algebra equation. So let's convert the 1,200 times 22. So this is 26,400 plus 7,200 equals purchases. So you can see by just making sure we don't get lost in the details or lost in the information, it becomes a fairly simple calculation. And that's essentially what I want to show you. Rather than, these textbooks for MBA students get wrapped up too much in the accounting without trying to learn the overall lesson. And the overall lesson I'm saying here is most questions you can do with the inventory equation if you apply it carefully. And if it requires more than that, then get your accountant to do it. That's what they're there for. So my answer here is 24,000. Is that one of the answers? It looks like it. And that's the right answer. Let's go on number 12 here. So preview question. So number 12. So this is a sales production budget. Sorry, it gives us sales. It is a production budget. Here are the amount of sales, finished goods inventory, had a selling price of $5 on all units. Expect to maintain ending inventories equal to 25% of next month's sales. How many units does? Okay, again, this is sort of paying attention to the units. We're given sales in dollars, but they're asking us units. So we need to convert one way or the other. We need to, and in the end, because we're trying to figure out units, we need to convert the sales dollars into sales units. So let's take that first. 280 divided by 5, because it says selling price of $5 per unit, and 224 divided by 5. Let's see what those two numbers give us. So this is 56,000 units, and this is 44,800 units. Okay, now again, we can just use the basic inventory equation. We can use beginning inventory plus how much to produce. This is our unknown versus how much we plan to sell plus ending inventory. So again, every inventory equation will have beginning and ending inventory. What you need to figure out, what is the number that it adds to the inventory? What is the number that decreases inventory? That's the incoming and outgoing. And the incoming goes on the beginning inventory side and the outgoing goes on the ending inventory side. So here, beginning inventory for the month is it does it a little sneakily. Finished goods inventory in August 31st. So whatever the ending inventory for August 31st is the beginning inventory for September, right? In other words, whatever amount of units we had in the warehouse on August 31st, 12 p.m. August 31st, at 12:01 a.m. September 1st, it's going to be the same amount of units. So ending inventory of August is the beginning inventory of September. So 19,600. We're trying to figure out how much to produce. We're proposed this 280,000. This 280,000 is what we're proposing to sell. And converted to units is 56,000 units. And then ending inventory. It doesn't give us a number, it gives us a calculation. Ending inventory must be equal to 25% of next month's sales. So next month's sales in dollars is 224. Next month's sales in units is 44,800. I think I wrote that number right. So what we want is, we don't want 44,800. We want 25% of that. So we want 0.25 times 44,800 is the number. So it's going to be 19,600 plus our production number equals 56,000 plus 11,200. So when I figure out the calculation, production should be 47,600. And yep, we do have that number. And it is the right number. Okay, so you can see here that of the four, and I'm going to, close this here for a second. Of the first four, 3 of them we could do by a basic inventory question. And the one that we couldn't, we did longhand. It was very complicated, but we're going to look at those again and show you, I'm going to show you that doing it by Excel. So I guess the takeaway is if it's a cash thing with a rolling window, you should do it with an Excel. All the other budgets you should be able to do with sort of a basic inventory equation. If it's too complicated to do with a basic inventory equation, then get your accountant involved, getting your accounting department involved. So those are the 2 things. Either you can do a cash budget with Excel, or you can do an easy production or materials budget with an inventory equation. And beyond that, you need to be getting some help. Okay, let's take a look at the next couple here. Now, let's see. I don't think I have the same numbers. So I had worked it out before just to make sure that it was all working straight. And sometimes they have something silly that they do. And in fact, in this one, they do have something that's a little bit silly. It's not too silly. It's just a nitpicky accounting issue. So I went ahead and built for all 3, actually. I went ahead and built all 3. But what I'm going to do is, this is how it's going to look, and what we'll do is we'll build it out again from scratch using the current numbers. So it says the cash budget is forecasted, and it says so as opposed to how it did before, to where it said 25% was in cash, and then it gave us the numbers for credit. Here it gives all the numbers together, 60%. So regarding cash collection of sales, 6% in the month, 25% in the month following, 15% in the month following sale, and the little sort of twist they add to this is 5% uncollectible. Second little twist is they give a 1% discount for cash payments made by customers during the month of sales. The accounts receivable balance in April is $23,000, of which H8 is March and 15 is, okay. So a lot of numbers, but I just want to show that we can take all these numbers and still figure out how much money that we're receiving in any particular month. Okay. So how do I build this? First of all, let me put this paper over here. Let's say March, and then I'm just going to drag this, and oops, it's a little crazy here when I'm using the big cursor. So you'll notice it may be hard to see, but it's going to populate them with the months. It knows that I want months, and so it populates them with the months. And if you want to center them, that's fine too. And here, I usually have 2 columns. I have a description column, and then I have a number column that I'm going to reference. So we're going to have a sales number. And when I say 0 month, that means in the month of sales. In other words, it's not 0 months ahead or behind. 0 months, meaning in the month of sale. And in this particular case, for those sales that we collect in cash, in the month, we give a discount. So we're going to have a discount, and that discount is 1%. Some of the questions say it's 2%, so you may have to put 2% there. And here, this is going to be 60% in the month of sale. So we're obviously going to subtract this from this to get, well, this is the amount that we collected that month. And so that's going to be a calculation. And then there are going to be a certain amount that we collect 1 month later. They call the following month. I just like to be very particular, very specific. So that'll be 20%. Then we're going to collect stuff 2 months later. That's going to be 15%. And let's see, that actually looks like it matches all of that as well. And uncollectible is 5%. So let's plug in our sales here. So for May, it is 100, 1, 2, 3. And if it doesn't show like this, because I've already got it, the Excel is copying what I've already done. You could do number, and here you can do a couple of different ways. I guess let's just try it this other way. Accounting, symbol, none. decimal places. When you pick accounting, it'll give you the comma separation, and if you have a negative number, it will put it in parentheses. And so how do I apply that format? You see there's this little paintbrush. I click on, I have the cell that I want that format to be over everything. So I have that cell highlighted or selected. Then I hit paintbrush, and then I can click and drag, and it'll basically say all the numbers that are in this will follow this same format. So here, let's see, 180. 190. We actually don't need August, but let's go ahead and put it in. Now remember, so the 60%, so for May, 60% is going to be here. The 1 month later is going to be collected here, and the 2 months later is going to be collected here. So I might just, let's build out some of the rest of this. Equals, you could go one or the other way, but let's do it this way. Let's take the number from this column, and you'll notice that the number will be, the cell will be up here. And what I'm going to do is, because I want to drag this formula, but I don't want to move this cell. I want this cell to be the same, but I want to, as I drag it, if I drag it over one, I want it to reference 180 times 60. Then I want it to be 190 times 60, then 120 times 60. And how you do that is you hit F4. Now you'll notice it put a couple of dollar signs around it. And what the dollar signs means, you're going to immobilize the column and the row. So if you want to immobilize just the column or just the row, then you use only one of the dollar signs in the column position or the row position. But I want to immobilize both, and so I'm just going to do that. We multiply by this, and we get 60,000, which seems normal, right? 100 times 60 is that. Now notice as I drag it, and if you click on this bar up here, it actually shows you what it's doing. So it's immobilized this one, but it's dragged over to this. When I click on this one, it's immobilized this number, and now it's dragged to that one. So we've done both. Now it says we get a 1% reduction. So what I'm going to do is equals 1%, and I want to immobilize that number times this amount, right? So that's going to be 600. And I can drag, and now it should be 1% of this, right? And now I'm going to say equals this number minus this. Now you probably identified I could have put 99% here, and that would have given me the same number. But at least by doing it this way, I am clear about what I'm doing. And if this number changes, I can always change it here. And it'll, in other words, if it was actually 2%, I could change it here, and everything would change. So this is, of the 60,000, we gave a 1% discount, $600, and therefore we collected $59,400. Now, here's the interesting thing. Well, collected 1 month later. Well, so this is going to be 20%. Now we're going to immobilize that number times what number? 20% of what? Well, it's going to be 20% of May is going to be collected in June, right? And if I drag this over, oops, that's moving the actual cell. If I drag this over, that means 20% of June is going to be collected in July, right? 20% of June is going to be collected in July. And this is going to say 20% of July is going to be collected in August. And we can do the same thing here with the 2 month. We can say 15% immobilize times May is going to be collected 2 months later. And when we drag that, we can see that 50% of June is going to be collected 2 months later. Now, the 5%, I guess it doesn't really matter because we're not collecting it, but I'm going to put it in the same month. So 5% is uncollectible. Okay. What we're trying to find out, though, is prepare a schedule of budgeted cash collections for May, June, and July. Well, if you notice, what are we collecting? So if I were to look at July, let's pick a color here. July is not going to be the 60%. It's going to be the 60% minus the 1%. It's going to be this amount. It's going to be the 1 month from June and the 2 month from July, right? It's going to be those three numbers. So if I do with this summary, we don't want the whole thing. We just want these three numbers, right? And so I can drag these over. Now, the problem is we don't understand what these three boxes are, right? We're given some information about it, but not everything. But what do we know? Let me do this. Let's say the May collection is this thing. This plus this plus this. Now, if you use Control and highlight each of these, you'll see down here, and it's probably very small on your screen, but it'll say 94,400. Well, first of all, 600 of that is a discount, and that would give it 95,000, and 5,000 is uncollectible. So if we added this number and this number, those 1, 2, 3, 4, 5 numbers add up to the 100,000. So what we need to do is we need to find out, if I were to highlight this, let's say, we need to find these numbers. Well, literally, we don't need to find that number, but it comes from April. And we need to find, maybe purple. We need to find these numbers. Ultimately, we need to find these three boxes. But one comes from April and one comes from March. So how do we do that? Well, it gives us a bit of information. It says the accounts receivable balance is at the end of April, so beginning of May, is 23, of which 8 represents March sales and 15% represents April sales. Now, this is the little bit of tricky thing. Now, you could pretty much put, because there's only one box for May, one box for March, right? Of the March information, we only have 8,000 here. So I could put March here. But what they really want you to do is they want you to kind of calculate all of it. So they want us to figure out, because it says here, hint, figure out by figuring out the total sales. So this 8,000, I'm going to put the 8,000 right above March. They're saying in the accounts receivable, 8,000 is for March and 15,000 is for April. Well, what does that represent? You might say this 8% represents 15% of whatever the total sales are, just like this number represents 15% of May. But then, and this is the tricky part that you wouldn't necessarily know. You have to remember that that the accounts receivable amount and the amount for uncollectible accounts are two separate accounting accounts. So this 8,000 not only represents the 15% that's being collected 2 months later, it's also representing the 5% that won't be collected. So what we would do is we would say equals 8,000 divided by, I'm going to put in parentheses, the 15% and the 5%, right? So that 8% represents the amount that we're going to collect in May plus the uncollectible amount. So the total amount here is going to be 40,000. Whereas the 15% is going to be the 15% divided by, and it's going to be the 20%, the 15%, and the 5%. So 37,500. Now, if I were to take out the colors here, let's take out the colors. I was dragging these to the right, but the truth is I can drag them to the left as well. So I can figure out this number, I can figure out this number, figure out this number. Oops, I don't want to move it. I want to. Now, this is because it's trying to reference a January number. So this would be January, February, and it's referencing this text string. So just don't worry about it. It doesn't affect this. But these should be the numbers, I hope. So if I were to put 72,900, well, let me see. Let me just fill in correct responses. Okay. 72,900, 132,545, 163,860. And I didn't sum these three, but I could sum them. 369, 305. So the key here is when you're figuring out these three numbers, you're figuring out those three numbers, you have to base them upon the correct sales amounts. And how do you do that? You have to remember the 8,000 represents the 15 and the 5%, and the 15,000 represents all three of these. So when you calculate those, meaning dividing by those numbers, then you get the correct total sales, and then when you pull the equation through, it works out correctly. And so if you had trouble working on this before, that's probably that's the one little key thing that they don't explain that is more of an accounting issue, that the 8,000 represents the collections in the following months, but also represents the uncollected amounts. Okay, let's take a look at the next one. So that one's a little finicky, but I think the other one should be a little bit better. Again, I think this one is so that was a cash collection. This is a cash disbursement. Again, we've got some information. Prepare a schedule of cash disbursements for these months. So what are we going to do? We're going to set up the same thing. So I will say this is February, and then I can pull this across, and I can center those, and then we have sales from which we're going to figure out COGS in this case. Okay, so yours may not be 70%. It appears the one that I figured out before was also 70%. But notice that the sales numbers are different from here to here. Then we're going to have purchases. And we're going to have wages. We're going to have operating expenditures or operating expenses, and we're going to have fixed costs. Now, each of these things are built upon a different idea. So it says lumber purchases and payments are to be made. Well, let's fill in these numbers. So 190. And again, I already have it set up that way, but if in case you need to set it up, so I will set up as accounting, get rid of the dollar symbol, and that way if we have negative, it'll be in parentheses. And then if you want to apply that overall, you can just map out a big area. Okay, so 190, 230, 240, 280, 260, 300. And it says cost of goods sold has been estimated 70% of sales. So again, we're going to say times 70%. We're going to immobilize that number. times February. So when we drag it across, the month will change, but not the 70%. In other words, if I click here, it'll be for the current month times 70%. Now, lumber purchases and payments are to be made during the month preceding the sale. During the month preceding the sale. So lumber is our cost of goods sold, right? We're a timber company. Lumber purchases. So cost of goods sold has been estimated for these amounts. Now, if this is the cost of goods sold for March, when do we pay for it? Well, it says in the month preceding. So what we're saying is the purchases for February are equal to the cost of goods sold for March. And if we drag that across, well, obviously the last month we don't have anything. But in other words, in the month, the lumber purchases and payments are made during the month preceding the month of sales. So this March's sales purchases, which is this amount, is here. April's purchases or April's COGS are March's purchases. May's COGS are April's purchases. So it's offset 1 month prior rather than what we looked at cash disbursements, which are afterwards. Wages are estimated at 15% and are paid during the month. Okay, so here equals 15% times sales. Oops, and I need to mobilize that, times sales, and we'll drag that across. Operating expenses, other operating costs amount to 10% of sales. 10% of sales, and are to be paid in the month following the month of sales. So February's operating expenses are going to be paid in March. F4 times February. So notice that purchases are paid in the prior month, wages are paid in the same month, operating expenses are paid in the month after. And that's very common. Certain classes of expenses are paid beforehand, some are paid afterwards, some are paid in the month. So just knowing the percentages is not enough. You have to know when those payments are required versus how much money is coming in. And then it says, additionally, a monthly lease of $34,000 is paid for computer services. So this is not dependent upon sales. It's just a fixed cost. And what do we want to know? We want to know, prepare a schedule of cash disbursements. So the total disbursements are going to be, and it's for April, May, and June. So it's going to be the purchases, the wages, the operating expenses, and the lease payment for April, May, and June. We want to know these three. And what are the totals? The totals are going to be here. So these numbers should match up with what is in here. 196, 182, 210, 36, 42, 39, 23, 24, 28, 34, 34, 34, 289, 282, 311. Okay. And so that's how to create that one. So not very difficult. Just recognize purchases are in the prior month, wages in the same month, operating expenses are in the following month. And then once you get those lined up, things should fall into place. Okay, let's look at the last one. So this is cash collections and disbursements and adding in a revolving credit, which is a very common situation for a business. So this is something that I think MBA students should know. So we are looking at October, November, December total. Let's go ahead and center those. And we're going to have, I'm going to map this to here. So we're going to have cash. I'm just going to abbreviate beginning, We have collection. We have cash available. We have disbursements. Cash ending. Now I'm going to put a star here because it says cash ending before we have borrowings. It says replacements, but I think they meant repayments. And then we're going to have a space. I'm just going to put in here a number. It says each month we need to maintain a minimum end of month balance of $12,000. So this is just a placeholder to remind us the number. And then we're going to have new loans, repayments, interest, and then true cash ending. Okay, so let's fill in the beginning balance. And let's make this an accounting number, none, no decimal places, and we will okay, so new loan is required a minimum of $12,000. It also says loans are obtained in increments of 1,000. Interest is 1% upon payable when the loan is repaid. So 1% at the time of repayment. Okay, so I think that's the information we need. Okay, so here are the collections: 38,000, 43,000, 83,000. Now, unlike the other two, when we've got this sort of contingent part of our equation, in other words, do we borrow a loan? Well, it's dependent upon whether our cash balance is less than 12,000. So we can't just map it out. We actually have to go through it month by month and allow it to populate. So let's go ahead and figure this out. So cash available is going to be whatever we started off with plus whatever we collected. So this is basically the beginning inventory plus adding to the inventory, right? So, and that number will go across. I'm not going to pull it to total because total is actually going to be figured out slightly differently. Now disbursements, they give it to us, minus 53. And you notice I typed in minus 53, and because I have it set up on accounting, it gives me the nice parentheses. And okay, so I'm going to add these two. This is the amount of cash I have. This is the amount of cash that I have to pay. So in essence, again, recognize that this is just like an accounting equation, inventory equation. Beginning inventory plus incoming equals ending inventory plus outgoing. So we're not doing anything new. We just have a new part of our calculation, which is a contingent revolving line of credit. And so what is this? We add these two together. Okay, so our minimum, comparing this to this, I have to borrow $1,000, right? So I'm going to borrow $1,000. I'm not repaying anything. And so ending cash is going to be the addition of all of these, right? It'll be my cash ending plus new loans minus anything repaid minus any interest paid. What did I? Oh, I see. Want to sum those. Okay. So I have 12,000. Well, the ending cash of October automatically becomes the beginning cash of November, right? And so I can actually drag that across. The ending cash of November is going to become the beginning cash of December. Okay, so now we've already got some stuff set up. We borrowed $1,000 so we could have ending cash of $12,000, which is our minimum. We have $12,000 plus we collected $43. That means we have $55 available. We dispersed, we paid out $63. That means we have minus $8,000. So in order to get to a minimum level of 12, we have to borrow $8,000 to get to zero. That gets us to zero. Plus we have to borrow another $12,000. So 8 plus 12. So we're going to have to borrow $20,000. Well, we haven't repaid any loan yet. We don't have enough money because we just borrowed, right? And we only pay interest, even though we've borrowed this $1,000 last month. We don't pay any interest until we repay the loan. So there's no interest. So if I were to say, what is my cash balance? Again, it's going to be $12,000, right? It's going to be, I was $8,000 in the hole. I had to borrow another $20,000 from my line of credit to give me $12,000. So I'm starting off December with $12,000. Well, you can notice we have a big collection in December, like a lot of businesses do. They collect a lot of money in December. So they have $95,000 available. Disbursement, the amount of payments they have that month is $40,000. So we're left with $55,000 in cash. We only need $12,000. So we have up to $43,000 we can use to pay back. Is that more than our loans? It is. So we can pay back. We don't need any new loans. We can pay back for all $21,000. Now the question here is, how do we calculate the interest? And this is maybe, of this particular thing, is maybe a little crazy. Well, let's take it point by point. It's going to be, we're going to have 1 month's worth of interest on the November borrowing, and we're going to have 2 months of interest. So if I take November, I'm going to have 1%. Let me just check to see it's 1% monthly. Yes, 1% simple interest month. Okay, because I was going to say if it's 1% annually, then we'd have to divide by 12. But 1% times the 20,000. In fact, I'm just going to reference it. Okay, so that's how much interest. If I only had that, the interest would be, well, I'd have to put it as a negative, but it would just be that, right? But it is going to be, let me type it again, equals 1%. And I could reference this if I didn't have another thing there, times the 20,000. Okay, so that's the amount of interest for the November. But we're going to have 2 months times 1% times the $1,000, right? So 1% on this would be $100 a month, so it'd be $200. 1% on this would be 200. Should be 1% on that is. Oh yeah. Sorry, 1% of that is going to be $200. 1% of that is going to be $10 times 2 months is $20. So that would be that number. Now I have to make that all negative. What do? There's a couple of things I could either make it negative 1%. I'm just going to put negative, then parentheses, and parentheses. Several different ways you could do this. Is no big deal. And so when I drag it across, I have 55, of which I'm going to repay 21,000 plus $220 in interest. So I'm going to have $33,700. Now here, the total, when you're doing something like this, doesn't quite always add up exactly how you would expect it. So new loans, yes, this is going to be a total here. A repayment, that's going to be a total. And interest is going to be a total. But beginning cash is going to be this number. Plus the amount collected is going to be all three of these numbers. And so the cash available is going to be 26 plus that minus the disbursements is going to be all of these. And so what is the cash ending? It's going to be equal this plus this. And then what did that? Oh, I see that accidentally summed the wrong way. This is going to be the sum of these. So this is going to be, yep, that should match out correctly. In other words, beginning cash was here. Ending cash was here, right? So here the total, the beginning cash should be this. The ending cash should match up with that. And then this is all that happened. We had this amount of collection. Therefore, the cash available is that. We have this amount of disbursement. Then the cash ending before loans. We had a loan of up to $21,000. We repaid it, and we paid $220 interest. So that should match up what we've got here. So if we fill in the correct responses, so 12, 12, 26, these numbers were given 164, 64, 55, 95, 190, minus 156, 11, 8, 55, 34, 120, 21. Oh, so all the numbers match up. So that's how you would do the cash, but so this last one, maybe it's not any harder. It's just paying attention to what goes where. In fact, that's all of accounting, paying attention to what goes where. But I think this one is very useful for MBA students. This budget is budget collection, receipts. It is paying out through disbursements, and it's managing a minimum balance in your account through a rotating line of credit. I think this sort of thing is very useful for you to practice to do. Okay, well, let's see if we. I think that covers everything here. Hopefully you got a little benefit out of watching me do the Excel. I think it's useful. This is not intended to be an Excel class, but just to show you that some problems are better served by doing Excel. So the better you are at Excel, hopefully you have good Excel skills. If not, if you have any questions about what we did here, just let me know, and I'd happy to do a Zoom with you and walk through anything. But hopefully you were able to follow what I was doing. Okay, if you have any questions, let me know, and I will talk to you soon.